With less than a quarter left in 2022. This year has been cruel. The S&P 500 index has amassed losses of over 21%, while the Nasdaq Composite is down over 35% year to date. The impact of Russia's invasion of Ukraine, soaring inflation, and looming recession continued to threaten the economy. Last week, the Federal Reserve increased short-term interest rates by further 0.75 of a point against its war on inflation. There are even reports of more interest rate hikes to combat the surging inflation. This continuously deteriorating economic situation calls for a change in investment strategies and portfolios. The stocks that were best buys a few weeks ago are no longer carrying the tag. Therefore, here we have compiled a list of the best stocks to buy in the month of November and beyond. Up first on our list of November stocks is the multinational tech giant based in the US, Amazon.com Incorporated, which trades under the ticker symbol AMZN. This tech behemoth is a name known to all for its online retail shopping services, as well as Amazon Web Services. It also offers an on-demand, over-the-top video streaming and rental service, Amazon Prime Video. The company made news this year through its 20-for-1 stock split, and gave way to a redefined optimism. However, 2022's bear market caused its shares to tumble well below its all-time highs. But the e-commerce and cloud computing leader's history proves that it always makes an even stronger comeback after each downturn. There are many elements to ensure a firm recovery and growth of the company. Its Prime Video has been growing steadily, with over 200 million members currently. Moreover, Amazon Web Services is a leading player in the cloud computing market. It has continued growing while expanding across the globe. In the second quarter of 2022, AWS added more than 200 products and services, while strengthening its partner network of over 100,000. New commitments for the service spanned a multitude of markets including travel and hospitality, media and entertainment, telecommunications, financial services, healthcare, energy, and more. Additionally, the tech giant is expected to report net sales of $125 billion to $130 billion in the third quarter of 2022, with an improvement of 13% to 17%. With a price under $120 per share, the stock is currently near its cheapest measure in around 5 years, at less than 3 times sales. All this makes November a great entry point for the stock, as it has a huge potential for growth in the long term. Up next is a global research-oriented biopharma AbbVie Inc, created as a spin-off from the giant Abbott Laboratories in 2013. Represented by the ticker ABBV, the company is focused on a wide array of therapeutic areas like immunology, virology, oncology, neuroscience, eye care, and women's health. AbbVie's key autoimmune drug is Humira, which was responsible for 36% of its total revenue in the first half of 2022. While the star immunology drug loses exclusivity next year, its recent treatments, Skyrizi and Rinvoq, have gained much popularity. Having earned approvals for most of Humira's indications, the drug's revenue improved by 56% and 85% respectively, in the second quarter of 2022. In the second quarter, the biopharma reported an increase of 21.4% in earnings per share, on revenues of $14.6 billion. The quarterly revenues improved by 6.1% operationally. Furthermore, the company's neuroscience division led gains with Botox for migraine, and Vraylar for bipolar disorder marking double-digit growth in the quarter. AbbVie has a vast portfolio of pipeline candidates in addition to these. Also, the company recently acquired UK-based private biotech DJS Antibodies Limited, for novel antibody development in immunology. Further adding to its value is AbbVie's status as a dividend king with a yield of 3.9%. Including the period before its spin-off, the company has raised its dividend for 50 consecutive years. Interestingly enough, the stock currently trades at a forward price-to-earnings ratio of 10.4, against the industry average of 12.7, making it a great buy. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving, or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Coming next is one of the fastest growing software companies, CrowdStrike Holdings, with the ticker symbol CRWD. This cybersecurity company went public in 2019, with just 10 software modules in its portfolio. But it has more than doubled to over 22 modules since then. CrowdStrike has achieved the gold standard in endpoint security, managed detection, and response while being a leader in threat detection and response services. Its customer base includes 69 companies of the Fortune 100, and 258 firms of the Fortune 500. The company's best-in-class solutions have fueled a strong demand for its services. In its fiscal 2023 second quarter, the cybersecurity firm marked an increase of 58% in its total revenue, to $535.2 million. Its balance sheet remained strong with $2.32 billion in cash and cash equivalents, while free cash flow surged over 84% year-over-year. What's more, the company boasts a massive dollar-based net retention rate of 124%. Moreover, this rate has not dropped under 120% in the past 4 years. In the second quarter, the company's new subscriptions increased by 51%. Vast technological advancement and adoption have made cybersecurity a necessity. Resultantly, CrowdStrike's addressable market is expected to grow at a rate of 13.33% per year until 2027. This leaves a lot of room for the company to grow and expand in the upcoming years. Additionally, the stock currently trades 19.2 times its sales, its cheapest valuation since early 2020. Thus, making it a great buy on the cusp of becoming a potential multi-bagger in the future. Following next is a leading Chinese electric vehicle maker, Nio Inc, which has taken a severe beating in the past few months. Trading under the ticker Nio, the company also offers various power solutions and value-added services like vehicle financing. The EV maker has been rolling out a minimum of one new product each year, with the latest sedans, ET7 and DY5, coming in over the 620-mile range. The considerable high range makes its electric sedans stand out from the competition. Despite the myriad of supply chain issues troubling its production this year, the company delivered 31,697 vehicles in the third quarter of 2022. This marks a remarkable 29.3% increase from the year-ago period. Moreover, as the headwinds ease, Nio plans to ramp up production in the final quarter with new models. The company is also taking numerous measures for expansion into Europe. It recently acquired a stake in San Jorge Lithium Project, Argentina, to secure battery raw materials for the long run and develop batteries in-house. This will further support Nio's distinctive battery swap network development. Although the EV maker has had multiple headwinds, it still pushed its second quarter revenues up by 21.8%, while boasting over $8 billion in cash and equivalents. The stock currently trades at 3.7 times forward sales, making it the most undervalued in reputable EV names. Down over 65% year-to-date, Nio's price target of $40 presents a massive upside of over 300%, which makes it an amazing buy for November. And the final stock for today's list is the American multinational media and entertainment conglomerate, the Walt Disney Company, with the ticker DIS. From travel to sports, broadcast to retail, the behemoth's products and services are present everywhere. 2022's downturn has made the shares of this world's premium entertainment company available at half its price, while the giant ensures its continuous adoption in the years to come. In the fiscal third quarter of 2022, the company reported better than expected results, with all important metrics going higher. The earnings per share increased to $1.09 from 96 cents, on revenue of $21.5 billion from $20.96. The company's park, experience, and product division remained robust, with a revenue increase of 72% in the quarter. Moreover, it has already reached over 152 million subscribers, keeping on track toward its goal of 230 million to 260 million subscribers by 2024. It even has a loyalty program in the making and a Disney Plus ad-supported tier rollout soon. Additionally, the entertainment giant will also be resuming its dividend payout once the economic conditions settle and it gains firm footing again. The widespread economic instability has the stock currently available at an attractive valuation, after being beaten down over 32% year to date. Its price-to-earnings growth ratio is 1.68x against the industry median of 2.41x. But add its accelerated adoption and expansion plans to the mix, and you get a great stock at a much discount to buy right now. That's all from us today. We hope that the insight we aimed to provide you will be helpful in upgrading your investment strategy and optimizing your November portfolio. We would love to hear your thoughts and opinions about our list in the comments section below. If you would like to know more about different stocks and the various investment opportunities they are better suited for, check out our website, stockstelegraph.com.